Now, with a seemingly ever-growing selection of ETFs and types of ETFs, it can be difficult to pick your go-to fund. Do you want to go with US or international? High yield or low yield? Active or passive? There are many things you should look for, but here are a couple of things you should have a look at no matter what type of fund you pick. Welcome back to another video talking about ETFs today, because sometimes we gotta go back to the basics. Please give the video a thumbs up if you like it. Drop me a comment if you have any questions about ETFs or my personal favorite ones, but keep in mind I don't hold any ETFs myself. Subscribe for more content. I post a video every day at 2 p.m. EDT or 8 p.m. CEST on Mondays, so stay tuned for that. Timestamps in the video description. Let's get going. So the first thing you'll have to do is to pick a category. Do you want to go with the US or Europe? High yield, low yield, big companies, small companies, and so on. Now, most investors go with a general one, like an S&P 500, but some want more specific ones. And ETFs are divided in by geography, risk level, the size of the companies, the type of companies and sectors they're in, or how the ETF is managed. Now, most go with the US or international broad ETF, like a Vanguard, the VOO or the VT or the VTI, due to their stability, low cost and decent yield. But if you want to have more risk and gain more exposure to industries that you think will do well, there are always some you can find. So I, for example, like technology ETFs, so I would probably go with something like the ARKW, the IGV or the VGT. So it comes down to your personal preference, and you don't have to go with the same ETFs like everyone else. So first off, pick a category. The next thing you're going to have a look at is cost. And this is probably the most important thing after you've picked a category. And you generally want the lowest cost. You see, a management fee of an ETF can really eat away at your profits. And there are some offering as low as 0.03, but some are as high as 1%. And if you have a category and it comes down to a couple of candidates, you should probably go with the cheapest one, because the difference between a 0.10 expense ratio and a 0.7 expense ratio over 30 years at 8% return is 20%. So just that small amount from a cheap ETF to an expensive ETF eats away 20% of your gains in the long run. So my advice would, if you go with a broad ETF, try and get below 0.10%. If you want a more specific one, it's going to cost you more. Now, the risk of an ETF is determined by the underlying assets and how the ETF is managed. But of course, a risky ETF is still quite safe compared to individual stocks. An example of things that can make an ETF riskier is small and fast-growing companies, companies in certain sectors like biotech or software. It can be an ETF tracking something like oil or Bitcoin, or it can be a top-heavy ETF with a lot of money in the top holdings. It can be an actively managed ETF where the manager wants to take more risk sometimes, or it can be a leveraged ETF where you actually invest for more money than you put in. So again, most ETFs are safe, but for some people, some ETFs are even too risky. So make sure that you feel comfortable with the risk level, especially if it's going to be your go-to ETF. Most ETFs track an underlying index, usually like an MSCI index. This means that the performance of the ETF should be the same as the underlying index. Now, it's never an identical performance, but the VOO should do roughly the same as the S&P 500, and the VGK should do roughly the same as the FTSE Developed Europe Index, and so on. And if it comes down to a couple of different ETFs, you should probably go with the one that mirrors the index you're looking for. This way, you can rest assured that you're invested in what you actually want to be invested in. Because some ETFs don't mirror the index. They just buy the same holdings, but not with the same weighting, meaning they are just hoping to roughly track the index. And sometimes investors don't even know what they own. Do you, for example, know how a commodity ETF like GLD or SLV tracks the underlying asset? Well, few do. So these funds are supposed to track the price of gold and silver. But what you're actually doing is you're buying shares of a fund that holds gold or silver. So you can buy shares of that trust, which in turn holds gold. So you're not actually an owner of gold, but rather in a trust that offers its own shares that will roughly match the price of gold and silver. Disappointed? Surprised? A lot of people are. So make sure that you know what the ETF does with your money. Most ETFs offer a dividend, and it usually depends on the sector, the country or risk level of the holdings. So financial ETFs usually offer between 2 or even 3% dividend. Tech funds usually offer below 1%. Now, a higher dividend doesn't mean a better ETF. It comes down to personal preference. The less dividend, the more growth. The more dividend, less growth, at least traditionally. But dividend can be a good stabilizer and help your returns in the long run. And a lot of ETFs investors are looking for dividend, but do not judge an ETF based on the dividend. ETFs are either passively or actively managed. If it's a passive one, it simply tracks an underlying index. So if it's an S&P 500 ETF, it automatically buys the same companies and the same percentages as the S&P 500. An active one can either subjectively track an index or just have a category, just a made-up category. It could be an ETF investing in video game companies, in social media. It could be like a millennia-themed one. It could be a blockchain-themed ETF, just some sort of title that roughly describe what sort of companies the ETF is invested in. The ARK Invest ETFs are a great example of actively managed ones. There are no indexes, no passive tracking. They are purely actively managed, where you have a portfolio manager buying and selling whatever stocks he or she wants and for how many shares they want. Generally, a passive ETF is cheaper than an active one and offers lower risk. But again, passive or active isn't better than the other. It comes down to personal preference, but do keep that in mind. If it's an actively managed ETF, you should check the expense ratio. Let's just put it like that. So at the end, I'll go through 3 points really quickly. So if it's down to like 2 or 3 ETFs, look for these 3 things. Inflows and outflows. You generally want a fund with inflows instead of outflows. Commission. Some ETFs can be traded commission-free through certain brokers. And if you're going to buy in chunks every month or every week or every couple of months, you should try and get the commission as low as possible or no commission at all. The provider, the big ones are like Fidelity, Vanguard, Schwab, and Blackrock. And it doesn't matter which one of these you choose. Pick the one that makes sense for you. So if you have a Vanguard account, you should probably go with Vanguard ETFs. If you have a Blackrock account, go with Blackrock. Or if an ETF is offered commission-free on your platform, you should probably go with that one. Once you've picked your category, you are probably best off going with the cheapest alternative, given that it decently tracks the underlying index that you're looking for. And you'll most likely end up picking a passive fund paying between 1 and 2% dividend, but that should be a cherry on top. And if it boils down to just a couple of choices, you can look at inflows and outflows, the commission and which provider that makes sense for you. Are you a Vanguard account holder? You should probably go with Vanguard, and so on. So if you're starting off investing and you're looking for your go-to ETFs, these are a couple of pointers to look at. If you want to know some of my favorite ETFs, it's probably going to be some quite risky ones like ARKW, ARKK, IGV, or CQQQ. But of course, most people just stick to like a Vanguard S&P 500. So make sure you pick a cheap and efficient ETF, maybe with a dividend on top, and make sure that it tracks the index you want it to track. Good luck with your ETFs. My next video will be a fun one on short selling, so stay tuned for that. I'll see you in that one.